The market is currently closed for the weekend. The final closing price for Ondas Inc., trading under the ticker symbol ONDS on the Nasdaq, was exactly $9.33 per share when the closing bell rang at 4 p.m. Eastern Time on Friday, June 12, 2026. This final price reflected a sharp intraday decline of 4.78% during Friday's highly volatile trading session. While broad market indices like the S&P 500 and tech-heavy benchmarks experienced mild headwinds, Ondas Inc. vastly underperformed its sector peers, trading down on heavy volume of over 18.5 million shares changing hands. This significant slide caps off a turbulent couple of weeks, where the stock has whipsawed violently between the mid-9s and the low 13s, driven by a fierce tug-of-war between retail momentum chasers and substantial institutional caution. To understand why this downward move caught so many off guard, you have to look past the surface-level headlines. The prevailing view among retail investors on popular online investing forums was that Ondas Inc. was ready to blast past its recent 52-week high of $15.28, fueled by a massive influx of government defense contracts and an absolute explosion in hardware demand. But the unexpected development shaking up the narrative right now isn't the contract flow, it's a sudden wave of heavy insider selling and structural share overhang that retail traders completely ignored. Specifically, CEO Eric A. Brock executed a massive sale of over 2.37 million shares, pulling roughly $31.9 million out of the stock. When you pair that insider exit with a freshly filed registration prospectus, signaling that more early stakeholders are preparing to offload their positions into the public market, the reality of incoming dilution instantly shatters the expectations of an easy upward ride. It highlights a widening chasm between the hype of autonomous defense tech and the hard math of public equity supply. The expectation held by the collective retail community is that small-cap defense names are insulated from secular tech sell-offs because global geopolitics practically guarantee endless backlogs. You see this sentiment echoed across popular investing sites and retail apps where users treat automated security and drone technology as an unstoppable secular trend. The common narrative suggests that because small hostile drone interception systems are essential for critical national infrastructure, any company putting up triple-digit or quadruple-digit revenue growth should be bought aggressively without regard for price. Online investment groups have increasingly lumped Ondas Inc. into the same high-momentum bucket as hot large-cap options, assuming that exponential top-line growth automatically equates to long-term shareholder value. The deeper reality, however, is that this stock has suddenly become one of the most polarizing battlegrounds on Wall Street, exhibiting classic traits of a high-stakes momentum play, where corporate actions are clashing directly with retail enthusiasm. High-profile institutional commentators have openly warned that the stock is behaving less like a stable defense contractor and more like a volatile vehicle driven purely by speculative fervor, cautioning that retail traders risk getting caught in a painful squeeze if the structural foundation cracks. This institutional skepticism is precisely what caused the asset to drop nearly 5% on Friday, as the reality of massive insider liquidations and technical resistance near the $13 mark forced automated trading algorithms and leveraged retail accounts to dump shares. Analyzing the intraday swings in trading volumes over the past month reveals an incredibly erratic pattern. Back in May, the stock experienced massive, unprompted spikes, jumping 21% in a single day to hit $10.72, and then surging another 20% a couple of weeks later to reach $12.99. All without a single piece of fresh fundamental corporate news. That is the footprint of intense retail accumulation and short covering, not steady institutional building. When an asset moves that fast on no news, it becomes incredibly vulnerable to sudden reversals. That reversal arrived in early June when the price slid 13% in a single session, a move that directly preceded the public disclosure of the CEO's multi-million-dollar share sale. Institutional activity indicates a sophisticated class of sellers capitalizing on retail liquidity to trim exposure, creating a heavy supply barrier that the current buying volume simply cannot absorb. When you scale out to look at macroeconomic pressures and sector momentum, the picture gets even more complex. High-growth technology platforms across the board are fighting against sticky interest rates and a market that is increasingly demanding real, unadjustable profitability over distant promises. Traders utilizing sophisticated setups on the Interactive Brokers platform or looking for advanced investment help are digging deep into the company's Q1 2026 financial metrics, which present a fascinating contradiction. On paper, the company reported a massive $50.1 million in quarterly revenue, alongside a staggering
staggering net income figure of $361.7 million. At first glance, a net income that exceeds revenue looks like an absolute home run. However, the reality under the hood reveals that these massive paper profits were heavily driven by non-recurring accounting adjustments and one-time non-core items, such as the strategic revaluation of assets and gains from recent subsidiary structural changes. When you strip out those non-operational boosts, the true core operating performance shows a business that is still aggressively burning cash to scale its manufacturing footprint. Because of these distorted numbers, the stock is currently trading at a trailing price-to-earnings multiple well north of 100 and a price-to-sales ratio that hovers around 50. This means that even with an impressive 1,000% year-over-year revenue jump, the valuation is stretched to an extreme degree. It forces the company to execute perfectly on every single upcoming milestone just to justify its current $5 billion market cap. For self-investing individuals managing their own capital through a Fidelity brokerage account or a Robinhood app, this extreme valuation introduces an immense layer of risk. Traditional metrics are completely detached from the current stock price, meaning the asset is priced entirely on future contract execution rather than current operational cash flows. Let's ground this analysis in what the company actually does, its underlying business model, and how it transitioned to its current operational state. Formerly known as Ondas Inc. before a corporate name change in January 2026, the West Palm Beach-based entity operates primarily through two core segments, Ondas Networks and Ondas Autonomous Systems. The Networks division is anchored by their patented FullMax software-defined radio platform, which provides secure, wide-area private broadband communications for heavy industrial clients like major railroads, electric utilities, and oil and gas conglomerates. The Autonomous Systems division is the primary source of the recent market mania, offering end-to-end automated drone data solutions and counter-unmanned aircraft systems. Their product suite features specialized interceptor platforms designed to neutralize hostile airborne threats, alongside autonomous security networks tailored for corporate and military installations. The business model relies on a mix of high-margin hardware sales, multi-year software licensing, and recurring hardware maintenance agreements. Historically, the company operated as a niche industrial communications provider struggling with low single-digit millions in revenue and persistent operating losses, an older performance history that looks radically different from the multi-billion-dollar defense narrative driving the stock today. Looking ahead, the central catalyst that everyone is watching is the upcoming Eurocidery 2026 defense exhibition in Paris. The company is locked in to officially launch their new layered autonomous defense operational command and control system known as Leidos. This software platform is designed to act as a central brain, integrating their entire fleet of drones, autonomous sensors, and countermeasures into a unified tactical network. Bullish investors are treating this global defense exhibition as a massive commercial opportunity that could spark a fresh wave of international military procurement deals, potentially pushing their pro forma backlog well past the current $457 million mark. Furthermore, their newly established joint venture in Europe aims to build a localized manufacturing hub to supply autonomous drone defense infrastructure directly to European borders and national security facilities, heavily targeting deployment needs in Germany and Ukraine. But even if these international expansion plans showcase immense promise, the near-term future outlook remains tied to a precarious balance of execution risk and market technicals. If the upcoming defense exhibition fails to deliver immediate legally binding order confirmations, the market's expectation will collide painfully with reality. The stock faces a persistent threat of further equity dilution, as the company needs to continuously fund its intensive research and development pipeline, which recently ballooned to over $13.5 million a quarter. If the tradable float keeps expanding through insider resales and secondary offerings, retail momentum will likely stall out, leaving late-stage buyers holding shares at a steep valuation peak. Comment below how many shares of Ondas Inc. you currently hold in your portfolio right now, and let me know if you think the recent insider selling is a major red flag or just a routine corporate liquidation. When you look at the big picture, the investment thesis for this stock is defined entirely by the massive divergence between structural market technicals and corporate execution. The expectation is a seamless path to global defense dominance, backed by an exploding backlog and high-profile international joint ventures. The reality is a highly volatile small-cap asset grappling with heavy insider selling, a massively inflated price-to-sales multiple, and underlying core operating losses masked by non-recurring accounting gains. Whether you are allocating capital through traditional vehicles like Fidelity mutual funds, utilizing automated tools like Schwab Intelligent Portfolios, or executing short-term momentum trades via online investing apps, navigating this stock requires looking past the surface-level revenue growth and keeping a hyper-focused eye on the incoming share dilution and near-term contract execution. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.